Hello and welcome to this week's episode for Conservative ETF Investor. I am your host. My name is Ken, Senior Market Analyst for Conservative ETF Investor. Our portfolio is up 37.29% year to date. We have a red for the stock market's strength color signal. The whole goal here is to beat the returns of the S&P 500 buy and hold investor. Their returns are up 25.18% year to date. So we are easily accomplishing that goal by a wide margin. And our portfolio is currently in cash. We'll go through all of our trades in this video right here. Today's intra-month video content is for retail investors and traders who want to beat the returns of the S&P 500 buy and hold investor. We're going to do a deep dive into the technical analysis of the S&P 500. We not only do the technical analysis, but we'll show you exactly how we trade our model portfolio, and we're going to share with you how we produce our decisions. I am not sure if there's another YouTuber out there that is this transparent. If there is, please leave their link in the description down below. I want to review that person's channel. We're going to review last week's trade and the model SPY portfolio, the equity curve compared against the benchmark, the S&P 500 buy and hold investor. We're going to go over the bond market, CNN business, fear and greed, seasonality, think or swim charts with technical analysis. And at the end, we're going to have the closing summation, closing thoughts, and on next trades. So with that, let's go on with the show. Last week, we did have one trade that we sent out to our subscribers. That trade was sent out on December 26, 2024 at 7:10 a.m. Pacific Standard Time. In the SPY model portfolio, we want to sell all shares of SPY and sit in cash for now. We'll go through that in great detail in just a second. So we're going the exact trade was sell 200 SPY at the market, which at that time was currently about $600 per share. Okay, now we're looking at a 10-day daily candlestick chart for the S&P 500. And by the way, of course, I use the ETF SPY, otherwise known as spiders, for all of our references to the S&P 500. Okay. Now, last week was a shortened trading week. You'll notice we skipped a day. 24th, we skipped 25th and went to the 26th because the 25th was a New York Stock Exchange recognized holiday. That's fine. So it's a 4-day week for last week's trading. So when we look at that, the 23rd is going to be Monday. Now, on Friday, the 20th, we put in a buy order to buy 200 shares of SPY at the market, which at that time was 582.29. About right here on this particular candlestick is when that alert was sent out. Now, we sat with those 200 shares. We sat on Monday. We sat on Tuesday. We skipped Wednesday. We went over to Thursday. Now on Thursday, this candle that you're seeing right here is a closed candle. But at the time I was observing the candle, the trading was down here close to $600 per share. And the candle, because it was lower than the close of the previous trading day, was a red candle. So I saw a red candle. I saw it lower than this high right here. And I thought that we were going to be looking at sideways action. Sideways to down, I should say. And so I thought we had reached some type of a plateau. So at that point in time, boom, the alert went out. Hey, let's sell our shares. Let's go to the safety of cash. Not knowing that the very next day, this market, well, there's a few things that I didn't know. Okay, let me clean this up. First of all, I didn't know that this candle was going to close the day with a clear candle, not a red candle. So in reference, if had I held it the entire day, maybe I would have said, let me see what one more day's worth of action would produce. But in this case, the very following day was that drop in the S&P 500. Now, an interesting thing about this Friday's action, this Friday opened here and closed here, hence the red candle. But You'll notice the long tail, and you'll notice this green line here. What's that green line, Ken? That green line is the 50-day simple moving average. That line was respected by the market, and the market bought at the 50-day simple moving average. Hence this, going up and closing towards the upper end. If you put the 50% mark here, it's right about here. We closed in the top 50% range of this candle. So that's not a bad day. Even though it was a red candle and so forth, that's still not a bad day. I wouldn't be surprised if the next trading day we're going to start to see more positive movement based off of just this action that we're seeing. We're going to give you so much content in this video. We're going to try to blow through it as quickly as possible. Okay, here are some of the trades that I've made in 2024. I've got too many trades to present here on one screen. If you want to see all my trades going back for 3 years, you can head over to this link right here. It will be down in the description down below. Also, if you want to sign up for my real-time trade alerts, it's the same link, and you can go over there and you can choose which plan you want to sign up for. Okay, now on our last trading for the previous week, here's that trade where we closed it out, $12.26, $600 per share. We picked up those shares at $5.82. Look at that nice profit we made on that last trade, $3,472. We started the year off with $100,000. Our current portfolio, which is in cash right now, is at $137,287, or a good, fat, juicy 37.29%. We can't be more happy with this number. So it's funny. Every time when I start the year off, we're going to shoot for try to get a return on investment of 10%. Once you reach the 10%, okay, now our next goal, let's try to get 20%. We reach the 20% mark. Then, okay, let's try to go for 30%. Incredible, right? We hit the 30% mark. Let's try to go for 40%. Man, I am less than 3% away from hitting 40%, but there's only 2 trading days left. I really don't think I'm going to do it, but I was really hoping to get a 40% bagger this year. That would, even this number here, 37.29, can't be more happier than that number right there. Okay, here is our equity curve for 2024. We have our model portfolio in blue against the buy and hold investor in pink. So noticing our blue, we have a nice slow and steady upward trajectory. You can see that we are beating the buy and hold investor by a good wide margin, especially towards this end of the year. Let's see, where's December? So December started right about here. So midway of December is when things started to go south for the buy and hold investor, and we were heading north. So excellent trading. Hats off to us for that. Last week, this is a weekly 5-year duration candlestick chart for the S&P 500. Last week, the S&P 500 gained 0.65% for the week. So here in the thumbnail, you can see the weekly candlesticks right here, and you can kind of see how the market has kind of been traveling south. And then on last week's action, this candle right here, we definitely came down, but it's not that bad. It's still not that bad. It's holding its own. Now, what else do we have here? We still have the negative divergence in play on the MACD. We have lower highs on the MACD, and we have higher highs on the price action. That's a negative divergence. That has not resolved itself. We need this to break out and go above that line for it to resolve itself. It has not happened yet. Slow stochastics, below its signal line, below 80 and traveling south. So these things tell me that there's a little bit more weakness. Now I have a projected move in here, which is this candle, this blue line right here, which represents the distance from this rising wedge pattern that I have drawn in here. Let me just clean this up so you can see it really well. So you've got support and resistance. You have a wedge. Notice how we go from here to here, and it goes to a wedge formation. Well, on that wedge formation, which we broke down out of, I have the projected move here that we could drop as low as 540 ultimately before this whole thing is resolved. That's still a possibility. That could absolutely still come into play. We have some seasonality bullishness going on here. First week of January is coming up, usually a bullish week, but anything is possible that can happen. So we're going to take it one day at a time here to determine our next steps. All right, now we're looking at a daily 6-month duration candlestick chart for the S&P 500. Bunch of stuff going on here on this chart. Now, I've got cycle brackets drawn in here in the bottom, and I can clearly see a low here and a low here. And actually, this low is based off of that one. This low is based off of that one there. This low looks like it's based off of that one right there. Now, what you have drawn in here is this line right here, like that, which is taken from that low to that low. Let me clean this up so you can see that whole thing. So now I'm looking at this valid trend line taken from these two well-positioned lows right there. We have broken down below that valid trend line. We came up, we surpassed it, dropped back below it. Now we've came right up, we kissed it, and then appears to be rejected off of it. So as of right now, we're traveling and trading below the valid trend line. It looks like a rejection off the valid trend line, and that could very well mean that there's more downside to come. This is the MACD down here. This MACD is below its signal line, and the histogram, look here in the thumbnail, you notice how this last histogram candle or projection here is actually larger than this one here, telling me that the energy is starting to go this way. This energy looks like it's going to continue to go that way. On the slow stochastics down here, you've got a clear topping pattern right there, still above its signal line. How much energy is it going to take for it to do this? Not much. It sure looks like we're going to have some downward bias action going on here. I've got some supports drawn in. So the first level of support is going to be this pink line, then this pink line, and then this pink line. Now, we can drop down all the way to this first pink line, which is about 583. And then we see if we hold support, which would kind of match. It does a whole bunch of stuff here at this 583 level. You see you've got this previous high, previous low, and also this low right here. So we're going to come down, match that previous low, and then take off. We're going to match that previous low and move sideways, match that previous low, and continue to decline. Unknown right now exactly how that's going to play out. Want to see if this is a true rejection off of this valid trend line or whatnot. Right now, we're safely in cash on our model portfolio. We need a little bit more information to determine direction. All right, now we're going to look at the VIX, which is the volatility or fear index. Now that's going to be the candlesticks. In blue, we have the S&P 500. Now I also have these green lines here. Above this green line is going to be the upper range that's bearish. Below this green line and above this green line, that's the low range, bullish. Below this green line, that's the ultra low range, which is also bullish. We are currently in the ultra low range. That's a bullish sign. And not only that, when you look at the trading, this is a daily, so these are daily candlesticks. You'll notice that on Friday's day, the market tried to get that volatility coming up there. And what happened with volatility? That volatility got rejected, taking us from this low range to the ultra low range. This area is bullish to be in that area. Now, let's continue on. Slow stochastics. Below 20, below its signal line, but boy, doesn't that look like it's getting ready to curl up? And the MACD, it's right at its signal line. It looks like it's traveling sideways. So kind of getting some cross currents here between all these different indicators to try to give us a feel for what's going on as far as fear in the market. Okay, now we're going to look at TNX, 10-year U.S. Treasury yield. So this is going to be a bond chart. And we got a lot going on in the bond market, and we got to watch the bond market. And the 10-year, which is what this chart is right here, is going to really be crucial to monitor in 2025 to watch our trading, because what the bond market does, the stock market is absolutely going to react to it. Now, the bond market is the candlestick chart. This dark green line here, that's the 50-day simple moving average. This black line right here, that's TLT, 20-year bonds ETF. And then in the blue, that's SPY, the S&P 500. So on the bond market, on the 10-year, man, we shot up. Right now, we're sitting at 46.19, 46.19. So we are way high. Look at the chart here. I mean, we're at the total upper end of this chart here on the 10-year bonds. So things are way high when it comes to the 10-year yields. The 20-year bonds, boy, they just went right straight down into the toilet, and they're just heading south with no sign of traveling north yet. The MACD is still above its signal line, but look at the histogram. Notice how the histogram is losing energy. Looks like it's traveling south. That can bring this back down. That can take this 10-year bonds and start traveling down. That could absolutely happen. Has not happened yet. If that does happen, you can bet your bottom dollar that TLT is going to shoot up like a rocket ship. And what is going to happen to SPY? SPY, unlike TLT that went into the toilet, you did have a softening here, and you did have a recovery on SPY, but it did not recover to the old highs. So far, it's a lower high. So far. Let's see if that changes. And so that's going to be considered a lower high until it does change. So currently, we have lower highs in the S&P 500. But if indeed the 10-year bond yields start traveling south, that's going to potentially give some energy for this S&P 500 to start traveling north. So we want to keep an eye on that. Also, here for the bond market, I monitor the yields for the 91-day, the 2-year, and the 10-year. Now, look what just happened last week. I monitor this every single week. 12/28/24. That's today's date as I'm producing this video. Now, on the 3-month or 91-day yield, 4.23, same as last week, okay? 4.23 is still below the 2-year and the 10-year, but look what the 2 and 10 did. In 12/21/24, the 2-year was at 4.32 and the 10-year was 4.56. Normal yield curve. Then, as of today, on the 2-year, 4.3, and look what happened to the 10-year. It dropped like a rock. It went from 4.56 to 4.25. Well, 4.25 is below 4.3. That's an inverted yield curve on the 2-10 ratio, a relationship, the 2-year compared to the 10-year. So that's a little bit of a concern right there, that now we're going back to an inverted yield curve. We just started that with the 2-10 relationship. So we're going to keep an eye on this and we see what's happening with this. But we were in an inverted condition for 2 years. So caution is advised, because after the yield curve normalizes, which it did on 12/21/24, we had a normalized yield curve. Well, at that point, and we've been normal on the 2-10 relationship for quite some time. We're just starting to get squirrely now on the 2-10. Maybe it's a 1-week anomaly. I don't know. We'll figure it out. We'll see what the trend is next week. But normally when you go from a inverted yield curve to a normal yield curve, 1 to 4 months after that, that's when the country itself is going to start seeing economic recessionary type activity. I would not be surprised to have that happen. Now, one thing that I heard during the week speaking about the economy, and I thought this was actually a true statement, was that the new President Trump, he's completely saying that tariff is his favorite word in the dictionary, meaning that he's going to put tariffs on countries bringing in goods to the United States. Well, the companies that purchase their goods outside or bring their goods in from outside of the United States, they know they've had some advanced warning that, hey, when he comes into office on January 20th, the tariffs could be implemented as soon as possible. So what are they trying to do? Companies potentially are going to start building up the inventory, bringing in their goods from outside the United States to inside the United States before the tariffs are implemented. Now, let's say that they do that and they build up their inventory so that the United States has a good inventory of product. Well, once the tariffs go into effect, they're going to be feeding off of that current inventory, meaning that the orders for future demand is going to dry up. So we may have some inflationary numbers now for built up, pent up demand for companies that want to bring their inventory in today so that they don't have to pay the tariff rates tomorrow to be better, more competitive against their competitors. So very, very possible in the first quarter of 2025, you could start seeing economic company where they're not going to be putting in orders for goods like they have been in the last quarter of 2024. So, and that could just be something that really kicks a slowdown into this country. So we'll see how that plays out. Okay, now here is our friend, Mr. Warren Buffett, the Oracle of Omaha, one of the best stock market investors of all time. And here is CNN Business Fear and Greed Index. We want to compare the current reading 34 to 1 week ago, 28. So 1 week ago, we were somewhere around here and, obviously somewhere around here now. So we're starting to come up on the fierce gauge that way. That's it. Nothing else to say about that. Okay, now we're going to look at seasonality. This is a 5-year look back for the S&P 500, and we are currently in the month of December. 75% probability you're going to close the month higher than when you opened it. Currently, for the month of December, the S&P 500 is down 0.92%. with a 75% probability that you're going to gain 0.93% between now and the end of December, according to this seasonality chart. So we could get a bump of 1%. There's a 75% probability that we're going to gain 0.93% over the next 2 trading days. Okay, now we are looking at the Thinkorswim platform, SPY 3-year weekly candlestick chart with standard deviations, +2, -2 in gold, +1, -1 in pink. The midway point is the dashed green line. We have a couple valid trend lines. We have this first valid trend line here. Then things started to get more aggressive and the market started to go up at a steeper angle. So I'm calling this a low and I'm calling that a low, hence this line right there. We dropped below it and then now we are trading right up against it on the backside of this valid trend line right here. Now I've got a couple of alerts for myself. The first alert here is if we do advance and we go to 608.55, that would be where the old highs are right there. And then I've got that low taken right there, 568.88. So depending upon which alert gets tagged will determine whether this market is going to travel north or travel south. So we're trying to figure that out, so to speak. But we're going to see and watch this market activity. Let's go ahead and switch over from the weekly to the 1-year daily. Let's switch the brackets to 1-year daily. Okay. Now, down here, I've got positive, neutral cycle, then a positive cycle, and then a neutral cycle here. Now we're in the next cycle. What is this cycle going to be? Is it going to be a positive, a neutral, or a negative cycle. That is yet to be determined. All we know for sure right now is that this is a high, and this, if it is indeed a high, will be a lower high. Not a higher high, not a neutral high, but a lower high. Lower highs are not good. So we want to monitor to see what this cycle is going to do here. We did pause out on Friday here. We did come down, but maybe it's just a one-day pause and it's off to the races starting on Monday. Still unclear. Need a little bit more information to try to figure this out. Now, let's look over here at the MACD. MACD here at the bottom, below its signal line, and it looks like it just wants to travel south. The candle here, the histogram is also traveling that way. So a lot of information here that looks like it's going to be more bearish than bullish. But we're prepared for it either way. Right now we're safely in cash. Let's let a day or two go by. Let's see what this market wants to tell us. Okay, now we are looking at a spreadsheet that I created to help determine the strength of various asset classes, as well as the 11 S&P 500 sectors. You can see I've got in here equities, real estate, precious metals, bonds, emerging markets, okay? And we want to compare the current reading, 26, to last week's reading of 20. So we are in a red signal for various asset classes, which is bad, but we are gaining a little bit of strength here in various asset classes. What about the 11 sectors for the S&P 500? Last week, 35. This week, 30. Well, that's not good. That trajectory right there is telling you that the S&P 500 as a whole is losing energy. It's not gaining energy, it's losing energy. It's already red. Caution is clearly advised here. We're in a red signal. We're losing energy on the 11 sectors of the S&P 500. So definitely we don't want to put leverage into this type of a market unless we were going short. This information that this is telling you, you'd rather be short than long. And being short may not be a bad thing to do because we're right underneath that valid trend line on the chart. What about if we're just going to tank from here? Be great to be short, but I'm not so convinced that the market is ready to do that yet. So I'd rather just sit safely on the side and wait for the market to tell me what to do. And I don't think it's told me that yet. A quick note about Warren Buffett here. Warren Buffett is sitting on 28% cash as of right now. So he's got a boatload of cash, a boatload to you and me. To him, a boatload of cash is $325 billion in cash and cash equivalents. But on a percentage basis, because this guy's got so much money, it's 28%. So for our own accounts, our own trading, it would not be bad to follow in Warren Buffett's footsteps and have 28% of your portfolio in cash just sitting there until this market figures itself out. Okay, we are next week, we're going to have the end of 2024. We're going to begin 2025, and we're going to begin that with a New York Stock Exchange observed holiday on Wednesday, January 1. So that will be no trading on that day. All right, that is going to take us to the end of this video. December 28th, 2024, the market summation, according to me, Ken, senior market analyst for conservative ETF investor. This market is deteriorating as noted by the red on the strength signal. Showed you that, showed you how we're deteriorating. I don't believe we have a good risk to reward ratio for going long. I am not so sure that I want to go short either. We're in cash for now, and I would like to see 2 more candles to decide next step. So in other words, 2 trading days. I would like to see that. Maybe I'll make a decision on Monday. I don't know. I'm going to be too hasty to be making any decisions. Our portfolio is currently up a nice fat, juicy 37%. compared to the buy and hold investors, 25%. I certainly don't want to make my track record, my return on investment here any worse. So unless I see something that's going to clearly give us a little bit more percentage gain, I'll just sit safely in cash. But I'll be ready just in case. I'll be watching the market just in case I want to make any transactional differences. I hope you got some valuable information out of this video right here. If you have not done so already, I want you to smash that like button down, subscribe to my channel, ring that bell. Head over to my website, Conservative ETF Investor. There'll be a link for it down in the description to see all my trades, to learn more about me, and to get my real-time trade alerts. I thank you and wish you good trading.